Okay.
There we go.
Yeah, now we're recording. Thanks for the reminder. Okay, so share screen. And so this is the book that Director Choi mentioned, which is this really quick book on background on state tax policy that you guys can access. There's also lots of information on our tax website. So there's old TR3 reports, materials, we can go through that. We put out a bunch of annual reports. So it's all right here. It's on earned income tax credits, the Hawaii business income tax statistics, which is a lot of information we get from the corporate income taxes and the S Corp filings, Hawaii general excise and use tax exemptions, which is all the exemptions, and how much and what are their tax expenditures associated with that. There's the Hawaii individual income tax statistics, which are also from the individual income tax return. So basically income, things like this, the amount of tax credit reports. And if you ever wanted that, we do put out a DOE tax annual report, and the first half of that report does provide a pretty good overview of the major tax types and trends for each of the tax types. So you might want to check that out. And then we have we've just launched these data dashboards. So I wonder if it's going to allow me. If we stop sharing and I go, I'll just show you these really quickly so you guys can get out. So just to let you know how to navigate here, you can go, there's a whole thing for the Tax Review Commission if you want to see this, right? And there, again, here's the 2015, the report, which I really encourage all of you guys to read. And then there's, even within all this, there's a lot of great information right in there. For the data dashboard, you just click right here. And so like, let's say you're interested in tax credits, right? Just click here and it provides all the information. You click the 2000, let's say you want to just do 2018. And so this provides you all the information, right? And so it has, this implies that there was $342 million in tax credits claimed last year. You see that the motion picture is the biggest. The number of claimants were 25. You can also see that the most commonly claimed tax credit is the refundable food excise tax credit. It was nearly 240,000 people claim this. So there's a lot of information here, and I really encourage you guys, there's collections data, GET, TAT, we're putting more and more data on it all the time. So if you're looking for trends, you can do this. The other thing that if you guys really want to get into the weeds, so let's say you want, like, this is the collections portal, right? And this is all the DOE tax collections by different tax types. So you'll see GET, this is individual income tax and everything. So let's say you wanted the data. This goes all the way back to 2000, by the way. So let's say you wanted the data for this. You just click right here and you download the CSV and you can get all the data yourself, right? So if you guys want to perform some kind of analysis or just want to do something, it's all right here for you guys. So I just wanted to, and this is all public information, everybody can access that, and it should be some good references.
Thank you, Seth. I just want to comment that I think that the information that's available on your website is terrific, and so this new information that you're putting on as dashboards is going to be really useful to us. I also really appreciate all the reports and the ease that we have to find all of the information from past tax review commissions. I have found those really fascinating, going back in time to see what past commissions thought were the most important tax issues. So I appreciate it, and I hope everybody has an opportunity to take a look.
Yeah, and one of the things I do find is, like, the question, a lot of things that people ask have already been asked, right? And so a lot of the information or a lot of past TRC reports includes a lot of good studies. And our tax system hasn't really fundamentally changed in the last 20 years, right? We've messed with the individual income tax rates a little, raised the TAT, but things have largely remained the same.
And just to ask this question, I know that there's a lot of information and maybe it would not be terribly useful to go in great detail in old reports, but would you say that it would be useful for us to take a look at some of the research and reports that were put together for the last 1 or 2 commissions because they're freshest and most pertinent?
Yes, I would. I mean, if I were you guys, I would read the last 3 like the reports from the last 3 commissions at least.
And the research that was put
Yeah,
into them.
and the appendices. That's what I would do. I mean, there's a lot of really good information. They've asked a lot of these questions that keep coming up and up and up. And if you guys have any questions about that, happy to answer it. And if they're, like I said, most of the things have not changed, but if there are you have questions, I can point out what has changed and what has not.
Thank you. Are there any questions or comments before we go on to the next item? Okay, thank you, Seth. And I think you are up next too.
Yes, so I am going to present. Let's do this. Do you guys see the whole screen or do you see like a slideshow or?
No, it's the whole screen.
The screen, okay, good. So, unfortunately for you guys, I think you're going to start hearing my voice for the next couple commissions, because the idea is to give you a number of different presentations on different aspects of our tax system, right? And I'm going to go into quite a lot of depth. The current agenda is to do one on the GET, one on individual income taxes, one on TAT and property taxes, and then one on like a comprehensive system of like looking at like distribution and who actually pays Hawaii's taxes. And as you have additional questions and other things, I'm happy to provide additional presentations. This is designed for you guys to educate you. So you, as you know, ideally by the, February, March comes around, you guys have the background information to ask more informed questions. So this one is on the GET. I'm going to open up with some basic ideas that, just about, if you read all the TRC reports, it all starts up with a general discussion on what's an ideal tax system. And then I'll touch on that, and then I'll just get to the GET. Does that sound okay with everybody? Perfect. And please interrupt me. I would much rather this be interaction. And if you have questions, we can just ask them as we go. So this can be pretty informal and interactive. So generally, there's 3 principles of taxation. There's economic efficiency, right? This is the idea that taxes are necessary for some aspects of life. And one of the you want to minimize the economic impacts of taxation, right? And so you don't want to have huge amounts of distortion on economic decision making through your taxation, unless it's on purpose, right? So there are certain aspects, like we have a liquor tax or we have a tobacco tax that is really high in the state of Hawaii, and that's designed to discourage behavior, right? It's not really designed to as much to raise revenue as it is to discourage behavior. But generally, we do not want that, right? Generally, we want people to decide if they want to build a car factory here in Hawaii, or if they're evaluating if you should build a car factory here in Hawaii, we don't want taxes to be a part of that decision. We want them to make that decision on their own, right? Because what we believe, as economists, we believe in markets, and like the private sector has a lot more information, right? And so by having minimizing our impact on the market, that's the best. That's the theory, at least, right? And then there's this other aspect of fairness. There's three ways of thinking about fairness. There's horizontal equity, and that's that same taxpayers with the same ability to pay have the same tax liability, right? So this is the idea that everybody who earns $1,000 should have the same tax liability. And so even somebody who's ultimately earns much more than 1,000, oh, can you guys hear me? Yeah, you guys can hear me. Okay. So this is the idea that everybody's should be taxed at the same time. So if there was, say, for somebody who made $100,000 and or even $1,000, the first $1,000 of income should be taxed the same way all the way across, right? If you don't do that, you end up with huge tax gaps and you impact economic efficiency, right? The other one to think about is vertical equity, right? This is much more about social values, which is who should pay as your tax liability rises, or should your tax liability rise as your ability to pay increase, right? And this is built in the assumption that as your income increases, you can pay more in taxes. You can use more of your discretionary income to go to taxes. But this is a very social, that's a social question, right? And you could have progressive, regressive, or neutral taxation. I'll talk about that in a minute. And then there's the other thing about fairness, which is usually discussed much more at the local level than the state level, but it's always there, is the tax liability is based on benefits received, right? So this is the idea, it's really, particularly on the mainland, this is the idea that if you want to live in a place with high taxes, high property taxes that have better schools and parks, you move there. If you decide that that's not important to you, you can move to a place with lower lower levels of taxation, right? Same thing goes with states, right? If let's say that all states are geographically neutral, just for the sake of argument, but you can move to a low tax state with lower levels of public services, and that's fine with you, or you can move to a high tax state with high levels of public services. In reality, I understand that high tax states do not necessarily equate to better public services, but that's the idea, right? And then finally, there's the compliance and administrative burdens, right? And this is how hard is it for a private sector company to comply with the law, and how hard is it for the government to collect these taxes? So just to give you an example of a tax in the way you think about it, that usually the simplest tax that you can administer is a poll tax, right? So a poll tax is basically every year I go around, the government goes around and says, I want X amount of money from you, right? $1,000 from each person. That's super simple to administer, right? It doesn't involve with economic efficiency at all. However, with fairness, we do not like this idea, right? And so that's why there's very few states, I don't know of any states that have a poll tax, right? So usually we want to only tax people in regards to some economic activity. And we're going to be using these criteria to assess the different levels of taxation, or the different types of taxation within Hawaii. And we'll go from there. So measuring progressivity or regressivity. I think these terms are tossed around a lot, but they're not well understood. So let me ask you a question. In a regressive tax system, who pays more taxes? High income people or low income people?
Low income.
Low. Percentage
Wrong.
basis low.
Yeah,
Basis.
exactly, right? So usually even in regressive tax structures, high income people pay more taxes in absolute terms, right? Because if you're, let's say we had a tax structure where anybody who made $10,000 paid 10% of their income, and anybody who made 100% or $100,000 paid 5% of their income. $5,000 is more than 1%, right? So it gets tossed around a lot, but it's really important to think about this, right? So we're going to assess whether the GET is regressive, neutral, or progressive, right? Now, let's just say for the sake of argument that it's neutral. That does not have anything to social things to say that like we should not ease the burden of taxation on low income individuals. It just means as a percentage of their income, it is equal across all income levels, right? And that's a decision for society to make, but it's really important. And what a lot of this will come down to is what we define as income, right? So a lot of people use income as a pretty good metric proxy for ability to consume. However, it is not the same thing as ability to consume. As we will see that like people's incomes go up and down every single year, and people's income patterns generally stay pretty much the same. In the United States, we have a pretty, I wouldn't say robust, but we have a social safety net, right? Which allows low-income individuals to consume more than their income, right? And as we go through life, there's certain points of life where our income goes up, but our consumption does not match that. And there's other points where our consumption surpasses our income, and we're going to talk about that. But this is really important to think about, because a lot of things when everybody says, oh, things are regressive, a lot of people, sometimes people are implying that like higher income people should be paying more, but that's what the true definition is as a percentage of your income, right? So usually high income people will always spend more on just about any other tax because high income people consume more, right? Or they earn more. And that's how we structure our taxation. Does anybody have any questions about that? No, okay. The other thing to think about when thinking about our tax structure is it's really important to think about the attributes of the locale, right? So what would be appropriate for California, which is the 5th biggest economy in the world with huge amounts of industry and wealth creation, and is probably you could argue that they should have a different tax system than in Hawaii, right? Or you can think of North Dakota, which is heavily dependent on energy and oil extraction, that they will have a different tax profile than Hawaii. So it's important to think about the characteristics of the economy. And what are some of the characteristics? One is we're isolated and distant from other economies, right? So if we had a high, this is important in terms of our GET, right? So in the mainland, especially on the East Coast where the states are really small, they're really worried about having a high sales tax because sometimes it's just worth it to drive across the state border to buy your car. In Hawaii, that's not possible, right? We export services, which is essentially tourism and government. We have a small land, small population with a narrow economic base, tourism and government, and we have a high cost of doing business. These are all things I think about every time people are considering different types of tax legislation, different taxes and tax policy. This is just a basic composition of the Hawaii taxes, right? And I think this is from 2010 to 2020, the last 20 years or 10 years. And it just shows you the relative amount of different taxes. What you can see are two big things. You know, GET has decreased slightly in importance relative to total tax collections, but it's essentially about 45% of all taxes. So it's the gorilla in the room. After that, there's individual income tax, which is increased slightly. After that is TAT and a bunch of other other taxes. A lot of people get really tied up with corporate income tax, but this is the corporate income tax. It's a really small portion of tax collections. And the question is, you know, how much time should you, a lot of people spend a lot of time on it, but it doesn't result in a lot of collection. So it's just something to think about as how you guys want to direct your efforts and think about how to formulate things. The other thing, here's Hawaii's taxation system on the left, the percentage of taxes versus a US average, right? And what do you see here? This is state and local taxes. Our property taxes are make a much smaller portion overall taxes than on average in the United States. That's because taxes, well, we can talk about that later in a second. We get more from our general sales, which is our GET, than the average thing, and then everything else is close-ish, I would say. But it's just important to think about like how we compare to the rest of the United States. The other thing is our tax collections are highly centralized, right? So we collect much more at the state level than relative to other states in the country, right? And so most of our tax collection occurs at the state level, which is GET, and that's because our property taxes are through a constitutional amendment, or due to the Constitution, is property taxes are collected at the local level. However, the main big thing is we have in Hawaii, things are very centralized, right? So our school system is administered by the state. It's the only country or only state in the union that does that, right? And as I mentioned before, there was, at least in the United States, on the mainland, there tends to be this thing where you're willing to pay higher taxes for good public schools, right? You don't have that trade-off here, right? So there's no incentive. It's very hard for people, and we can talk more about the governance of the tax system and how taxation creates accountability with people and different things. But it's much harder for somebody to rationalize like, oh, I'll live in a different portion, like I'll move to Kailua because the schools are there, even though the property taxes are higher there, right? And so so I'll stop there. And in terms of localization. Now, the other thing that is really important here is we export a lot of our taxes, right? So our visitors and the non-resident military pay a large part of our consumption taxes and GET. 1 out of 11 people in Hawaii are either active military or related to active military, and most of those people are not residents. So they don't pay individual income tax, but they do, when they're off base, they pay GET and they contribute to our economic things. So that's why if you look at, state tax per collection, this is only at the state level, we're some of the highest, right? But when you take state and local level, we're much lower. And that's what I'm showing here. When you are thinking about taxes, you want to think about different types of adequacy too, right? You got to pay for, basically you're trying to pay for what you're spending on. And there's 3 ways to think about it. You take short run tax adequacy, which is like, are we going to make it through this budgetary period? Long-term tax adequacy and stability, right? And so one of the things with long-term tax adequacy is you don't want your taxes to be insufficient. So like, let's say in some states, it doesn't really happen here in Hawaii, but some states, they're constantly needing to add more taxes to just pay for basic services, which go up with the prices of inflation, right? Without major policy changes, you generally want your taxes to reflect inflation and collect just as much as you did the year before, because the cost of government services goes up by 2 or 3% a year without adding any major policy changes. So what happens in Hawaii? Like I would say we're relatively stable. So on average, we're about 8% of all of GDP is collected in taxes. And you can see we move up and around with, different, this was after the financial, the .com boost. And here's the Great Recession. It's going to be down to, it's going to be really low now, but generally up until now, I would say our taxes had been relatively resilient, and you can see we go up and down every single year, but they generally stay the same, which is what you wanted. You wouldn't want something to be 8.1% here and 5% down here, unless you did major decisions about reducing the amount of government spending or government services, right? You want it to stay around the same. Does anybody have any questions about that? And then here is just another kind of cross-state poll about tax revenue volatility. And you'll see that we're 27th in the country, so right in the middle. So this would suggest that between GET, individual income tax, and a bunch of them, we're pretty good. What you'll see here is, if you look out here, you have basically two types of people. You have like really energy dependent states, right? And so they have a lot of their taxes related to oil extraction and things like that. And since commodity prices go up and down, you have California, which is really dependent on high income individuals, individual income tax, which is problematic because they go up and down with income taxes. And then down here are generally places without any extraction taxes and without any individual income tax, because individual income tax and corporate income tax tend to be the most volatile. Consumption taxes tend to be relatively stable. Okay, so I'm about to move on to GET. Do you guys have any questions about just tax principles, the tax system overall?
I do have a question. You described our system as being relatively stable. What is the answer to the question about its adequacy?
So the adequacy is interesting. Long-term adequacy, we haven't really incorporated the pensions in ETF into a lot of our considerations, right? And so the legislature had passed something several years ago to make it obligatory to pre-fund the pension system, and it was looking better and better. But given the fiscal crisis that we're in, the governor has decided not to make those allocations, which are significant. I think it was going to be $350 million a year. Right, and then the EUTF is also problematic because you cannot pre-fund EUTF. It's a pay-as-you-go system. That's a medical care for retirees, right? So you can't really pre-fund that as easily, but they were going to start paying into it. So in terms of adequacy, it's a wash. Now, one thing I'll get to much later is, the difference between, and it won't be in this presentation, but I'll mention as much as I can because I think it's something that people don't get through. But the difference between revenue growth, yearly average revenue growth of 4% and 2% is a full-on fiscal crisis, right? So because when we're thinking about these questions of 30 years on, 2 years of percentage growth is huge. That's like $10 billion extra dollars or $15 billion extra dollars, right? And so a lot of the times when I work with legislatures and reps and things, and they want to balance the budget and raise something by 50 million or lower it by 100, something like that, they all want to do their little things. But really it's going to drive our adequacy in the long term is growth. If there's no growth in Hawaii at all, and there's no economic growth, and since our economic growth matches our tax revenue growth matches our economic growth, then we're in big trouble, right? If we do grow, then that gives us more money every year to pay more teachers, pay off our pensions, things like this, pay for the climate mitigation. There's a lot of costs that are coming up, and it's not impossible for the state to pay for. However, it's much more difficult if there's no growth. So GET. what is the general excise use and use tax, right? So GT is formally a gross receipts tax that is imposed on the privilege of doing business in the state of Hawaii. And then we have the use tax, which applies to purchases from out-of-state vendors that are not required to collect taxes. But essentially, we have a really broad gross receipts tax, which basically means that like whatever a business has in terms of gross receipts, you're supposed to put 4% on it, right? Unless you're a wholesale rate, in which case it's 0.5. Now, it's incredibly broad, and we're going to talk about the benefits and costs and benefits of that tax. I wanted to compare it to a sales tax, which is what a lot of mainland people are more used to, and then what a value-added tax, which is our taxes that are commonly used in Europe and Japan and most other countries in the world, actually. And so a sales tax is just levied on the customer officially, but it's collected by businesses. It's different from GET, which is levied on businesses. And sales tax traditionally is only on tangible goods, right? So Hawaii is really weird that like if you hire a lawyer to do something, they have to pay GET on those services. In most states in the country, you don't have to pay a lawyer. You don't have to pay for any inputs, right? It's just on tangible goods. Normally, even this is starting to change, but you know, normally like if you went to a yoga class or anything, you don't pay sales tax on a yoga class. In Hawaii, you do. And then there's the value-added tax, right? And the value-added tax is the one that economists love the most because you don't tax business-to-business transaction. And when you tax business-to-business transactions, it or you're only I should rephrase that. You are taxing business as a business, but you're only taxing the value added of each of what a company puts in. So let's say I'm a car manufacturer and there's a value added tax, right? And I buy my inputs from a engine maker for $1,000, right? The engine maker is going to pay whatever value added they did, right? So they say, I bought all my inputs for $500. So they would only pay, and they sold it for $500 to the car manufacturer, right? So they would only pay $500 on that tax. And then the car manufacturer, let's say they put the car together and they sell it for $2,000. So they would only pay $1,000 on that tax, right? So you're not taxing any of the inputs, you're only taxing the value that you create in. And this is the type of tax system that is, you know, usually it's in Europe, it's all over the place. Economists really like it because you're not distorting any types of economic decision making. It's a pure consumption tax, right? So what is the ins and outs of the GET tax? It provides slightly less than half of the Hawaii's general revenue. It's on gross income. We have a two-tiered system, right? So one of the problems that I'll talk about with consumption taxes, gross receipts taxes, is it leads to tax pyramiding, right? So this is the idea that if you tax all the inputs at a 4% rate, you're going to get a much higher rate in the end. I'll talk about that in a second. But that's why we have the wholesale rate at 0.5% and the retail rate of 4%. It also works in the case of Hawaii because we don't have any manufacturing. Like a GET tax probably wouldn't work very well in, let's say, Ohio or a manufacturing state that like buys and assembles lots of that, because even if you only had to pay 0.5% on every single time you have a little wholesale rate or input rate, it really adds up when you do this over and over and over again. The GT is really good because we don't have a lot of exemptions, and one of the problems with sales taxes is every legislature has their own pet project and wants to carve out an exemption. We don't have that many for them. The taxes is levied on business. We put in the use tax to make sure that, you know, you can't get around our consumption tax. So even though we don't make cars in here, if we bought cars, and if you bought a car on the mainland and you import it here, you still have to pay use tax on that. So we have this gross receipts tax, but in reality, it's more like a VAT because we have this, we have deductions and we have the wholesale rate, right? We tax ideally all inputs. Now, ideally, like we wouldn't tax, and when I say ideally, I just mean from an economic point of view, right? Really minimizing business to business transactions, right? And so should we be taxing lawyers? Maybe for their input, right? But like we shouldn't be taxing lawyers the whole time because they also pay for like accountants, and they also pay, like, part of their bill is the accountants and the computers and everything, right? And of true VAT, they would only be being taxed on the amount of service that they would provide, right? So if they had to farm out some of the other things, they wouldn't be taxed on it. In the case of Hawaii, we do. However, in generally, like, we'll look at this, but the tax pyramiding isn't so high. We exempt insurance premiums, public utility companies, but they pay alternative taxes. We exempt, to reduce tax pyramiding, we exempt the cost of subcontractors because building, there's a lot of like inputs there. We have a big one, which is the refundable income tax credit for GET paid on purchase of capital goods. So that means if you're building a factory, right, you don't have to pay GET on that because that would be considered a capital good. And then we don't tax SNAP, which is food stamps, right? Because you're not allowed to tax anything provided by the federal government. These are some examples of like our top exemptions. We offer some exemption. We offer about 40 exemptions, and here are the big ones. So you can see there are certain ones that like the amount exempted, but like if we actually thought about the cost, the tax expenditure, it would be zero. So like foreign trade zones, if we got rid of this, we would expect the people just to do business in another foreign trade zone outside of Hawaii, right? So we wouldn't expect that. Nonprofit organizations, we don't tax that. We could, right? But this is a social decision, and the cost. So we're, in this case, we exempt, or at least nonprofits requested 5.9 or nearly $6 billion of exemptions, which would equate to roughly $240 million of GET tax revenue. This is basically hospitals, right? We have the subcontractor deduction. We do this to reduce pyramiding, and you can go on and on. A lot of our biggest ones are like about taxes. So taxes passed on or out-of-state sales. We could tax this, but generally you don't want to tax your exports, right? And anyway, you either tax where things are consumed or where things are produced. And we usually tax, this is a consumption tax, right? So since we have the use tax, we're going to tax everything that the people in Hawaii are consuming. So we don't have to tax our exports. That's the idea. We don't tax prescription drugs because it's a social issue. Can't really, we exempt sales to the federal government because we don't want to make ourselves uncompetitive when we're making bids to the federal government, and they can move everything around. Maintenance fees are high, but these are maintenance fees are basically your condo fees, right? And in which case, normally not taxed in a consumption tax. And in fact, the wording for the GET is so broad that we have to carve out certain things to make sure that they aren't taxed, right? Like we have to explicitly say that real estate transactions are not taxed, right? Because the wording is so broad. So here's the little way to compare all the different ways GET sales via VAT. And the taxpayer who's responsible in the case of GET, it's the businesses. The coverage, what I mean by coverage is how many things are taxed by the GET. Sales is narrow, right? Oops, sorry. Sales is narrow because they typically only tax tangible goods, whereas we tax everything, right? VAT taxes everything all as well. Here's what's taxed. Are inputs taxed? In these two cases, no. In our case, yes, but they usually get the wholesale rate, even though that's not always true. And the administrative burden, and I'm talking away for businesses, is quite low, right? Because you just take your total gross receipts and say, this is what you owe. For sales tax, you have to create a separate account for anybody who buys anything. You send it to, because it's not officially yours, you send it to and you send it to the government. Plus they have tons of exemptions, right? So like in most places, food, grocery market food is not taxable, but cooked food is, right? So if you go into a convenience store and buy a burrito, frozen burrito, and you take it out with you, that's not taxed. But the minute you microwave it, it's supposed to be taxed, right? So it creates a lot of little like small things that we get away with because we just tax everything and make it easier for ourselves, right? VAT is higher because you have to demonstrate your value added. And that's what's kind of like higher about the compliance, right? So the trade-offs of the GET is the pros are low administration cost, not that much in the way of market distortion. We'll talk a little bit more about that. Broad base and low rates, hard to avoid, and it's exportable, right? So our military and our tourists pay about 30% of the GET. One of the cons is regressive. We're going to talk about a lot about this, and the problem is tax pyramiding, and we're also going to talk a lot about this. So just in case of why GET is really stable and good, is this is GDP, this is normalized, so it basically makes it comparable. But you can see in the green line is GDP, and this is GET, and it goes almost follows it perfectly, right? Which is exactly what you want. Here are some other ways of comparing ourselves. So we have amongst the lowest tax rate, sales tax rates in the country, 44%. We're like 45th in the country, yet we raise the most per capita of just about any other sales tax or consumption tax. And the reason is twofold. One is we have the broadest scope of anything, and two, we have lots of non-residents paying into our GET system, right? This just goes to show you our GET has been incredibly stable. So since its beginning in 1962, we have not changed the rate at all. That's incredible. We have not changed our principal GET 4% rate since 1962. So this are three different things. This is the sales tax rate of Hawaii in green, California in red, and Texas in blue. And then this is the US average for tax rates. But you've seen since 1962, Texas and California have had to raise their taxes much more than us. And on average, sales taxes have been going up and up and up. Why is this the case? Well, traditionally sales taxes only tax tangible goods. In the 1960s, tangible goods represented about 33% of household spending. Now, no, it represented 66% of household spending. Now it represents 33%. We just spend more on services and less on things now. Our GET was designed to handle that, so it basically captured all of these things. In other states, they've had to catch up by increasing rates after rates after rates. So the GET is, I mean, I can't think, there may be other cases in other states where it's been the same for the last 50 years, but it's very rare, right? And now we're coming up on 60 years with no rate change. So it's pretty remarkable.
How do you view the increase from for the rail project, to fund the rail project?
This is just state sales tax, right? So if we included municipal things, it would definitely go up, right? And so that would happen right about here.
It's treated as part of the GET, isn't it?
It is, but we've separated out, right? So we have the 4% GET, and then we have the county surcharge, which is a 0.5% for Honolulu, 0.5% for Kauai, It was 1/4%. Now it's 0.5% for the Big Island, and Maui doesn't have anything. We move this out. This is just sales. This is just state sales taxes. If in the case of Hawaii and California, where I live, where I'm from, it's much higher, right? Because they tack on county taxes as well. So this is just for states.
And Seth, since there is a certain amount of pyramiding, I guess is the term, is the actual percentage of our sales tax really 4%, or is it actually perhaps higher than that because we're taxing several things on the step towards selling it?
Yeah, I love it when I'll get to that in 2 slides. So it's a perfect lead in, if that's okay. Just as a reminder, and we've done this, there's been multiple studies that looks at the amount of GET that's exported. When we say exported, it means like that we have we have non-residents who presumably get less benefit from being a citizen of Hawaii than residents. How much of them do they pay the GET? And it's, it varies between 28 and 37%. It's usually around 33%. And this conforms with what we're seeing right now, right? So right now for a while we had no tourists, and our GETs is about down 25% on the year, right? So this really conforms to what we're saying. We think tourists contribute about 22% of our GET, and non-resident military contribute the rest, right? So non-resident military provide, again, it was really important in terms of our exporting of GET. So tax pyramiding, right? Like I wanted to go into this. Now, I broke down the numbers, but tax pyramiding is bad, or economists think it's bad. And that's because you have a tax on a tax on a tax. And the more inputs you have, the more the effective tax rate becomes higher than the statutory tax rate. So and sectors with more inputs are disfavored, right? So, and the other problem is generally you want to know what is the effective rate of the tax, and you don't want it to be hidden so you can have people make decisions. So let me just go through this really simple math decision or mathematical formula to get to the idea of a value-added tax. So say there's a retailer, right? And at one point you have to buy fabrics, then you have to they put it together, they sell it to the store, and then they sell it on, right? So the fabrics cost $100. The wholesaler sells it to the retailer for $200, and the retailer sells it to the final customer for $400. In each case, there's a total of value added of $400, right? And if we just said that tax rate was 2. So if we just did a tax on each one of these subsequently, we would have $2 on the first one, $4 on the second wholesale rate, and $8 on the $400 rate, right? So that's $14 in taxes. If you take $14 over the true value added, that's a 3.5% tax rate. So the pyramiding, we would say, is 100, or is, yeah, it's not 100. This is wrong. It's not 150%, but it's much bigger. It's like, yeah, it's 150%. And that's the problem with tax pyramiding, right? And that's what we want to avoid. So I did a bunch of studies, and other people have done a bunch of studies, and what you find is because of the wholesale rate and the other exemptions, the pyramiding rate is 4.7%. Now, this would be higher with the county surcharge, right? But it's not as crazy. Some people have said, oh, the effective rate, it's like 10 or 12%. Our studies suggest it's not. It's around 4.7. And all taxes pyramid upon themselves, what you want to do is minimize it. So it doesn't appear that tax pyramiding is a huge issue when it comes to the GET. This relates to our tax structure, but again, it also relates to our economy. We are just not a manufacturing economy that has lots and lots and lots of inputs, right? I broke this down by sectors, and you can see that the 4.72 rate is across the state or across the economy, but there are certain sectors that pay more, right? Agriculture has a slightly higher one, food processor, manufacturing, and these all make sense, right? Even professional services, businesses, these are ones with higher levels of inputs, right? Agriculture, you need to buy a lot of different inputs to create something, fertilizers, seeds, that thing. Manufacturing, tons of inputs. The professional services and the business services are probably higher because their inputs are not taxed at 0.5%, they're taxed at the 4% rate, right? So not everything is equal here in Hawaii. You guys have any questions about this? So easy. Okay, so now we're gonna get into like regressivity and progressivity. So GET is less regressive than the headline numbers suggest. And let me tell you why. Or first of all, why is GET usually considered regressive? And it is regressive, right? By some definitions. It's because lower income people spend a larger portion of their income on consumption. However, let's think about these definitions for a second. One is studies tend to overstate regressivity on consumption taxes because they don't account for the differing consumption patterns over a lifetime, right? And so generally elderly people and young adults consume more than their income. And when you're in your middle 40s and 50s, you're in prime earning ages, that's when you save also the most, right? And so in people who make the most save the most, but they're usually going to spend it later, right? In fact, all income is going to be consumed. What's the point of having income if you're not consuming it, right? You could give it away in a tax, in which case it may not be taxed, but even in Hawaii, we would, like if you give it to NGO and they spend it, they're still going to pay GET on that, right? So ultimately, all GET or all things consumed in Hawaii are taxed at the GET rate, which would mean that at any different income, you're always paying around 4% of your income. And then the other thing to think about is this whole definition of income, right? We usually think of income as a proxy for consumption. However, because our social safety net works to some degree, you know, you can argue whether it's robust or not or enough. Low-income people are allowed to consume more than they make, right? And we do this through earned income tax credit. We do this through food stamps or SNAP, low-income rental credits. We just do a lot of income, not a lot, not as many as other countries like in Europe and stuff, but we do engage in that. And that means that, like, you know, sometimes you'll see like GET and like taxes paid by low income people in Hawaii, and it's like 11%. And you're like, God, that's so high. How does that even happen? Especially since our rate, GET rate's only 4%. Well, that's because they can consume more than what they're making, right? Their denominator, the income, is lower, but their actual consumption rate is higher, right? You can't, no low income person can pay more than 4% of their entire income or entire consumption on GET, right? They just cannot. But if they consume more than their income is, then they can, that rate goes up. That's how you get the higher than 4% rate. Now, we're going to look at like whether they still pay more than high income people, and that's true. But again, what I want to stress is lifetime savings patterns matter, right? So generally when you're younger, and this is getting pushed out more and more as younger people go to school longer and longer. I took out, you know, I was a consumer for a long time. I got my PhD, right? So until my mid 20s, I consumed more of my income and I lived off the student loans, right? And now I'm in this portion of my life where I'm saving more, right? And eventually I'm going to retire. And, you know, anybody engaged in estate planning says that the goal is to spend your last dollar that you own on the day that you die, right? You can't take it with you. You can give it to your kids, but even if we gave it to their kids in this scenario, they would still have to pay GET as long as they spend it in Hawaii. So one way to think about this is over the course of a lifetime, GET is not regressive. Everybody pays the same amount because it's, now, we should remember that as a portion of your income, whether that's fair or not, that's a societal information that like maybe lower income people should be paying less in taxes, right? And we'll go over that in terms of our whole tax system. But just in relation to GET, when people say GET is regressive, what they mean is in any particular year, the GET is regressive, right? Let me see. Yeah, in any particular year, the GET is regressive because there's certain people here, high income earners, that are saving, and so they're not consuming it. And low income earners, which are these people, are consuming more, right? So that's what it means by over the course of a lifetime. So anybody have any questions about that? Because that goes against what is always talked about in the press, and it's not always accepted when I say, because we always say the GET is regressive. But what I'm saying is GET is not regressive over the course of a lifetime if you use the definition of regressivity as the amount of tax paid as a percentage of your total income. Wow. I did this to a bunch of legislatures this morning and I got yelled at. Oof.
Well, it's because most people don't accept that argument. That the points that you made about low-income people getting extra benefits, tax credits, food stamps, whatever, that's all valid. But most people, when they talk about regressivity or progressive tax rates, they're not talking about over someone's lifetime. They're talking about point in time, and point in time it is regressive. So most people, even though this graph and this argument is completely accurate, most people will reject it because they care about what's happening now, not what's going to happen to them 30 years from now.
Yeah. And most studies show that consumption patterns are pretty constant over a lifetime, right? So whether it's even when you're a kid, like young adults, they consume relatively the same as when they're elderly people, right? And so you can think of this, make this a personal thing, right? Like I save money sometimes, and there's been moments in my life where I like decide not to work for a year, right? And so this is often what happens. And you're absolutely right, Murray. Like in a defined point in time, it is regressive. It's just over the lifetime, and it's up to people to decide what is important, right? And so it's just important to think about things that, because one of the things that you're gonna, the GET is the easiest way to raise the revenue in Hawaii, right? It exports them, other than the TAT, it exports the most to non-residents. But one of the things that people always push, and why one of the reasons you haven't seen it raised at all since 1962, is it's common, like people say it's regressive, so we can't raise this tax type, right? Because it would be a disadvantage lower income people, right? So this is kind of like, I put this out just to get people thinking about things. And what we're going to talk about later is you also need to look at the tax system as a whole, right? We have a bunch of tax credits that are supposed to mitigate the fact that lower income people pay more in taxes on any given year than higher income people. And when you look at the tax system as a whole, we do a pretty good job of like mitigating the cost of GET on lower income people. So this is me using the Consumer Expenditure Survey and looking at GET burdens across income quintiles, right? And what you see is lower income people pay more and less. So this is a truly regressive, this is by definition regressive, right? There's one caveat here is I assume that GET is born on rents is borne by capital owners. Now, if you don't buy this, then it's GET is super regressive, right? Because we tax GET on rents, but we don't tax it on home ownership on mortgages. So lower income people are more likely to rent. So they're more, if they're actually paying the GET, then they do. We're going to discuss this a little bit more, but generally in Hawaii, I think there's a lot of science to say that capital owners, the people who own it, pay the GET versus versus the renters. And I'll talk about that a little bit further on. But it's important to keep in mind that assumption, because if it's not that assumption, then GET is incredibly regressive because low-income people are the ones paying rents. This is adjusted for individual income taxes. So like if you're looking at disposable income, this is more accurate. So since we have a progressive income tax structure, this lowers the disposable income of people. And then if you take into account that we do not tax SNAP or food stamps, this lowers the regressivity level of the tax as well. So on any given point in time with SNAP and after income taxes, this is how regressive our tax structure is. Again, usually you can get these more than 4% rates because these people are consuming much more than their income, right? That's the only way you can get a 4.8% rate. And then if you did think the argument was over your course of a lifetime and all consumption or all your income will eventually be consumed and taxed, this is what it is. So this is by definition a neutral tax. Right? Any questions on this? Okay. So is the GET regressive? Let's go over it. Over 1 year, yes. Lower income households consume more than their income than higher income households. Over the lifetime, I would argue no, right? And I would also argue at least the way, you can argue about psychological and power of having more money versus fewer resources. And I think that's a really interesting argument. But what most of our social safety net is aimed at consumption, right? And so our in-kind benefits is designed to make sure that people don't live pure nurse lifestyles in the United States, even though people still do. And we're not there yet, but it's designed to boost consumption at lower levels. And that's one of the reasons why these in-kind transfers, they allow people to consume more than their income, along with savings. Does anyone have, okay, so then going back to housing, yeah.
I have a quick question. It's kind of unrelated, but related. Why does the state tax unemployment benefits?
Because generally we tax all income, right? So you either tax income coming in or going out. And an individual, like so since you guys are receiving that, you are supposed to tax it, right? So like other states do not tax it, but we do. And we use it with the rationale that it is income given by the government, right? And you tax that income. Does that make sense?
Well, not really, because food stamps you still get a benefit from.
Well, food stamps we're not allowed to because it's provided by the federal government, right? So you can't tax any benefits from the federal government. In unemployment insurance is not from the federal government, it's from the state.
Yeah. I'm just thinking about the rationale behind it, but
yeah. The rationale is you tax income, you tax money given to people. And so like you either tax it coming in or taxing going out. So for example, and I'm sure we're going to get to this conversation.
Seth, this is Ted. Did you want me to add to that?
Yeah.
Yeah, and so another principle just in general in terms of taxation is whether or not the income is, particularly in this context, whether or not it's replacing the wage. So that's kind of the distinction here, and obviously unemployment is also taxable at the federal level for income taxes, which is distinguished from something like compensation for damages. Let's say you're injured on the job or whatever it is, and that is intended to compensate you for any harm that has occurred, which is a little bit different from replacing the wage. So the concept there is exactly that, just following what the taxation would have been had a wage been paid in a normal course of employment instead.
Okay, I got it. Thank you.
Thanks, Ted. So just to I think I like to always think about housing here in Hawaii, because housing is one of the primary social concerns that we have in Hawaii. And so how does GET affect Hawaii housing costs, right? So we do not tax mortgages, but we do tax, and we do not tax the implied rents that we homeowners get from owning their home, right? Switzerland actually does, interestingly. So Switzerland actually says if you own your home and you pay rent, you are essentially paying rent to yourself, and we're going to tax that. We don't do that here in the United States, and we don't do that here in Hawaii. However, we do tax rents, right? And so the question is, who is bearing that? And the question of all GET is, who really bears the cost of the GET? Generally, we think that the consumers are the ones that bear the cost of the GET and not the capital owners, right? In reality, it's much harder to figure that out, but that's the assumption we make. With housing, with rent, it's here in Hawaii, and if you compare it to studies that have been done on the mainland, generally, there's two types of housing markets in the United States. There's housing markets like San Francisco, New York, I would include Hawaii in that, where there's much more demand for housing than supply. And then there's places like Texas, where the demand for housing, where the supply of housing really adjusts to the demand for housing, right? And so the cost of a house comes much more down to the cost of construction than the cost of land, right? So what happens when incomes go up, but you don't build more housing? It means people who own the housing get monopolistic rents, right? And in that case, the GET is renters or people who are renting are already getting monopolistic rents from the renters, right? And so they are already incorporated, they're getting such a premium that the 4% is below that, the tax is below that. So the way to think about this is, if we eliminated the GET, we created an exemption for all rents on the GET, would rents go down by 4% across the board in Hawaii? That's the thought experiment. If you believe that, then the GET is incredibly regressive and spurs our housing price. If you believe that, most people who own a rent are getting some kind of profits and it's the capital owners who do that, then it's not going to impact rents or homeowners. Rents as much. So that's just something to think about. And this is basically what I said. The other thing is, in terms of when you're talking about adequacy and things like that, small changes in the GET have really big revenue implications. So like 0.5% raises about 430 million one way or the other. So if you lowered it, this would decrease our general fund revenue by 6.4%, or you can increase it, right? So that's just something to think about. And I'm going to finish up with just a little assessment, and I'll be doing this for all of our major tax types, looking at it by the metrics that we laid out at the beginning of the presentation. And so in terms of economic efficiency, it's broad-based. targeted exemptions keep tax pyramiding relatively low. There is still some tax on business-to-business transactions. However, the wholesale rate keeps it low, and it's been a while. So, and we don't find huge impacts of tax pyramiding. The broad scope does not favor one particular sector over another, which is good. Whereas in the case of sales tax, we are favoring services over tangible goods, right? Because we only tax tangible goods. In terms of fairness, in the short term, it is regressive because lower income people spend a larger percentage on tax consumption. Longer term, not as regressive. Administrative burden, it's pretty easy for businesses to comply with this. And from a tax department, it's pretty easy as well, right? We just match the gross receipts with what people are saying on the individual income tax, and we should have a good idea. In terms of stability, it is very close and very stable with GET. So that's it on my presentation, and I'm happy to answer any questions that you guys might have.
Any questions or comments?
A kind of quick question. This is Scott. Is there any estimate as to how much GE tax is not collected because people don't actually do their receipting or do any receipts? Cash crops, small businesses, lunch wagons.
Ted, you might be able to answer this. We do have SES, which was created, a special enforcement section that was originally created to go after really cash intensive industries, right? Because when everything's done in cash, it's harder for us to keep track, but I'll let Ted talk to that.
Yeah, I don't think we have a actual an estimate of, I guess, what's commonly referred to as the tax gap in the cash area. And it's kind of one of those things, you don't know what you don't know. But I'll say that, you know, the special enforcement section's emphasis is in that area. And obviously with the pandemic and all of that, the means by which these businesses operate is a little different. So we are looking at kind of changing how we watch and kind of ensure compliance for these smaller businesses that were formerly cash and at these types of events and places. So no, the answer, sorry, Scott, we don't have a straightforward answer.
Well,
to what
and another unrelated one, but
sure.
Also for just the income tax. It's funny because we just recently, as you know, I'm the finance director for Maui County and we administer the CARES Act. And it's interesting that a lot of people didn't ask for rental assistance because their landlords don't pay income tax on that rent that they're receiving. So they couldn't get the CARES Act reimbursements. So just, it was kind of odd, but there's a lot of people who couldn't get that rental assistance because the landlords aren't paying their fair share.
Yeah, we've heard that too. We saw that in the news, and I think that was the case with the state program that HHFDC is the point on, which is similar to the various county programs. But what we did ask is that if the administrators of these programs are aware of who the taxpayers are, if they could let us know. We have our complaint info. You can either send it to us or Seth or me, but also we have a email address and a phone number on our website that you can send complaints to. So we'd appreciate it. We do follow up on all tips due to confidentiality. Obviously, we can't share the results, but we do follow up on everything. So that's an additional way that you guys can help us support compliance.
Thanks, Ted.
Thank you.
There's no commissions here, I guess, then.
If that was only the case.
Seth, can I say something, Seth?
Of course,
Sorry, Chair, can I say something, Chair?
Yes, please.
On the tax gap question, you can go to the IRS website, and it says tax gap, and if you want to follow the exact same percentage as them, it's about 14%. So you can look at our total revenues. About 14% would amount to the tax gap if you want to follow the IRS norm, and I don't see any reason why we shouldn't. Number two, of course, our job is to protect revenue. So any naughty taxpayers like the landlords who hasn't paid, of course, we're going to go after them. You know, Elton knows we're practitioners. You know, every single time somebody qualifies for the rental credit, and we say, oh yeah, you qualify for the rental credit. You know, go get your landlord's GE tax number and address, and they come back and say, no, never mind, all taken care of. So you know the landlord just donged them $50 for the credit, right? So you know that's just you know the way it is. But yeah, we will have different initiatives to make sure that you know we protect the revenues of the state. Thank you, Chair.
Thank you. Any
And
other
I
questions?
would can I just follow something up with the Director Choice? That 14% is only on individual income tax, right? So I would assume that the individual income tax that 14% would apply to our individual income tax. It would not apply to GET because it's a consumption tax. So my guess, Washington State did some compliance looks on things, which has a gross receipts tax that's very similar to ours, and the compliance rates were really low. They were like 3 or 4%. Or non-compliance rates were low.
Non-compliant rates.
Yeah.
And I did tell you, Seth, I disagreed with you.
Yeah.
Anyway.
I have a
not-
sort of a related question, Chair.
I think Sale had his hand up next.
I just had a quick question. So, you know, in that earlier slide where we were talking about the effects of raising GET, you know, that was a pretty material amount. How would you characterize the resistance to, is the argument against raising the GET rate primarily the regressive one?
I'm not the politician. There's a politician on. I'm not going to talk about why people decide not to do something or something else. But Ted or Director Choi?
Yeah, I'll plead the fifth.
Yeah, I don't have anything really to add. And just my personal opinion is that getting to a place where we raise general excise tax is going to be based in need, and obviously due to the pandemic, we're closer to that point than in the recent history, even closer to that point than in the 2009 recession or 2008 recession. So we'll see what the legislature does.
Fair enough. Thank you.
Kate?
Yeah, mine was a question sort of related about, you didn't talk a lot about use tax. And I mean, I understand the structure is to sort of equate in-state and out-of-state sales, but that one seems to me to have a higher compliance issue around it. Are we successful in collecting use tax, and what percentage of that, how does it compare with the GET?
We have a line for use tax, so I can give you, I don't have it off the top of my head, but I can provide you with the percentage of use tax as a part of GET. Like,
let me just provide some background information on that, just down to that question. This is Ted. The use tax issue was a little bit murky prior to Wayfair, in that we weren't a sales tax, and the question was always whether or not a seller needed to be physically present. The Hawaii courts, even before Wayfair, several times held that you didn't have to be physically present to be engaged in business. That being said, fast forward to 2018, Wayfair came down, and we know that a economic nexus standard. So in that case, the South Dakota case, they had the same standard as us, just $100,000, 200 transactions. We could subject them to sales tax. As Seth discussed earlier, general excise tax is even less burdensome than a sales tax, in that there isn't a mandatory collection requirement. The imposition is on the seller, so they would just be being a percentage of their gross receipts. But to add on to that, Hawaii passed a marketplace facilitator law. So what that means is that if a seller that previously claimed that it wasn't their sales and they're just providing a forum, and there's several out there, I think Target does it, Walmart does it, Amazon does it, they sell third-party things, those sales become the sales of those platforms. So obviously they're already over the $100,000 standard, whether or not they have physical presence. So The use tax, and what I'm getting to is basically all those sellers that sell on these platforms get aggregated into the platform. So there's less of a use tax issue today than probably there was before.
Got it.
Yeah, and so
Understand.
I can tell you that even in the years before Wayfair, if you compare the number of individual, so I believe it's Form G26, number of individual use tax forms that were submitted to the department, there were very few. And so we have 1.4 million citizens, and not everybody's a taxpayer, but even if you took half of that, 700,000 people, I'm sure all of us back in those years purchased something online that use tax was probably due. And so that's one thing. But to kind of add to that complication, it's really hard for a consumer to know whether or not general excise tax was due or use tax was due, because there isn't a mandatory pass-on requirement. And why that's important is because there's no, therefore, if I was to go online and purchase something and there wasn't general excise tax passed on, it doesn't mean that that taxpayer is not subject to that. So the right way to go about it would be for the purchaser to ask the seller, hey, you're not passing this on. Are you paying general excise tax? Am I subject to use tax? Is one way to go about it. And the seller might be forthcoming and say, well, I'm under the thresholds or whatever it is, and use tax would be due. But one thing, again, going back to our tip line, if anybody is purchasing something and they think general excise tax would be due, in other words, you kind of estimate that more than $100,000 worth of items were purchased by Hawaii consumers in a year, you should definitely, again, provide information to our special enforcement folks, so the tip line or the email address, and we'll follow up on that. And so it might be as simple as you purchased more than $100,000 and you're wondering why general excise tax wasn't passed on, and therefore we know. But we have to go through the examination process to actually make a determination on it. So there isn't a straightforward answer, but that's kind of the lay of the land. So I guess in a nutshell, what's important to remember is that we're in a way better place today because of the Wayfair law that was passed and Marketplace Facilitator.
Helpful. Thank you.
Sure.
And speaking of that, is there a way do you have a report on how much GET you collect for e-commerce?
I don't believe so. So for the commissioners, I'll say this. Generally speaking, the data that we would have is represented on the tax return. So if it's things on the tax return, like the G45, G49, or Schedule GE, chances are we might have some data on it. And we do obviously do revenue estimating and those kind of things, and that's Seth's group. But in terms of hard data, it would be limited to what's on the return.
And Chair, if I can add, your tax department is looking at your huge online sellers without a presence in Hawaii. So we do have initiatives going now to make sure that we level the playing field with the local businesses. So it's not something that's not off our radar screen. We are actively looking. In fact, we're looking right at this second, and we'll continue doing that because a large percentage of the purchases are made through online sales. So you can kind of rest assured that we're on it, without breaking any confidentiality. Yeah, thank you.
More important now than ever.
And I would also point out that like the use tax compliance is probably higher in Hawaii than it is on the mainland, because you can't drive across the state line, buy something and drive back, right? Which is a big issue. Like in Delaware, in New Jersey, people don't buy cars, and people who live in New Jersey don't buy cars in New Jersey, they buy cars in Delaware, right? Because the sales tax is 2 or 3%, and on a huge purchase, it makes a big difference.
Are there any other questions? I would just like to say that I have been one of those people who has gone around talking about how regressive the GET is. And so this is very eye-opening for me, and I'm going to have to absorb it and talk to some other people who have been telling me how regressive it is, to compare notes with them, because it certainly looks like it would have some advantages to possibly expand the GET, but I still would be, everything that I've ever heard is how regressive it is. So I need to absorb that some more.
One time, I think it's IETP that like puts out this report, and it's like, I think it's 11% or something, like it's something normal. And I remember calling, I called the national office and asked them how they got that number, because it just seems so high to me. But yeah, I'm with you.
Yes, thank you. Okay, well, if there is nothing else, thank you very much for the presentation. That was very informative. And I think we can go on to the next item, which is the schedule for our next meeting. And I believe we had tentatively set that for, I can't remember the next date. Do you have that handy?
Yeah, I thought we were kind of going for the third Wednesday at noon, if that still works for everybody. So that would, in January, that would be the 20th, January the 20th at noon.
Good, so we can do that. We can have our meeting instead of celebrating the opening of the legislative session.
That's another big date for other things as well.
Does that appear to still work for everybody?
Does anybody know if they're going to have an opening for the ledge?
I'm sorry, what was the question?
For the opening of the ledge, is that going to be in person, or is that canceled? Does Director Choi know?
No, nobody told me anything, but I don't think we're gonna have a big opening, because I already heard about the hearings. It's gonna be, the building is gonna be closed to the public. So if the hearings are gonna be closed to the public, I'm gonna assume opening day is gonna be non-existent, I guess.
Okay, thank you. That's helpful.
So are we shooting for a 2-hour block for the recurring?
I think that is what we were shooting for. Is that
Okay.
acceptable?
Yep.
Okay, we'll see how it goes. We will try to wrap it up sooner in a shorter time if we possibly can. Okay, well, if there is no further business, I wish you all happy, safe holidays, and we'll see you in January.
Okay.
Thank you.
Thank
Bye.
you.
Happy holidays, everyone. Thank you.
Bye.
Thank you.
Bye.